If you want to become a professional price action trader, then this is an absolute must-watch video, and I'm sharing some of my favorite price action systems and price action techniques that I've learned over the last 15 years being a trader myself. And let's not waste any time and we get right into the video. We are starting with a trend shift, and this is a very great trend following trading approach, and we're using a very simple indicator, the daily high low and price action principles. In TradingView, it's very simple. You just open your indicator and you type in daily high, daily low, and then this is what you will get. And what this does is that it gives you the channel. The green one at the top shows you the previous day high, and the red one at the low shows you the daily previous low. And this is a very, very important concept. When the market pushes into new highs, you will see that generally speaking, you're in an uptrend. When the market then suddenly pushes into new lows, such as here on the right, then you are more in a bearish environment. And then we are breaking through a support level. The price is establishing itself here at the lows. It is not pulling back immediately, and this market is really staying here below its daily previous low. And this is then often signaling a new long-term downtrend. So at this point, this is where you want to look for shorts. Maybe you could even go to a lower time frame, look for shorting opportunities. But this is where a new long-term bearish trend might emerge. You can see this is where it happened after the breakout. The market trends lower. How is the downtrend unfolding? At the previous day low, you can see the market keeps pushing into the red level, which means that it is breaking into new lows every day, or almost every day. The market is making a new daily low. It's a very, very bearish signal. And when this signal changes, and when then suddenly you see the market is breaking into a new high, that's a very significant change. This is not happening during a downtrend, right? Here you can see the market is making higher lows, and we are breaking into a new daily high for the first time. And at that point, you will shift to a more bullish dominated scenario. You can see this is where it happened. The market broke into a new price high. The market stayed at the high, stayed at the high, stayed at the high, until here we break the flag. You also come below the daily pivot point, another very important signal. You retest the flag from underneath, and you also retest the pivot. You break into a new daily low the first time, and then you can see the market also breaks completely into a new low. And this is where you shift more towards a bearish scenario once again. We can zoom out and we can see very nicely to overall long-term bearish structure. This is where we broke out of the pattern. We have a very strong bearish phase, very weak flag pattern, and then now you would assume the market is back into this long-term bearish mode. From here on, you really want to get short into this market. Here, this is where this happened. How is the downtrend unfolding? First of all, at the daily lows, then below the pivot, and this changes once the market retests the pivot point as support, where it has been resistance in the past. We break here into a new daily high. This is a very, very bullish signal and a very bullish change. And then you can see after this happened here, we trade higher. How is the trend unfolding? Above the pivot, outside of the daily high, and this changes here. We break into a new daily low. We break into or below the pivot. We have the double top, and now we shift to a more bearish scenario. So this is a truly helpful indicator to understand trending markets and to deal with trend changes. Before we continue with the video, I want to show you my new trading program. I call it the Tracademy. And this is the ultimate all-in-one trading education program. What you will find here is a completely new trading course. I've recorded over 80 videos with brand new trading content. The videos in this trading course have never been shared anywhere else before, and I go way deeper than in all of my YouTube videos. Also, you get mentored directly by me. I'm not using other teachers, I'm not using other coaches, I'm the one that you're always interacting with. There are live webinars taking place almost every week, and there's also a private community with other traders from all around the world, and also me. I'm interacting with all of my traders in the Tracademy directly and personally. So you join the new video course, you get personally mentored by me, you have new trading strategies. They are completely brand new strategies. I've never shared the videos before. They are for swing trading, day trading, and for all the time frames. There's a great and supportive community. It works for Forex, commodities, cryptos, and also indices. Everything that I've learned mentoring traders for the last 8 years and having been trading myself for over 15 years is included in this course. There's also a certification program. So after you've gone through the course and you have learned the material, there are 60 trading questions waiting for you where you can prove your knowledge and then at the end get certified. So if you're interested, make sure to check the video link in the description below. If you have any questions, leave a comment. And if you decide to enroll, I look forward to welcoming you in the Tracademy. Now let's take a look at another liquidity concept, and we want to take a look at stop runs and liquidity runs. And those can be really helpful, especially for break and retest traders. So what we have is in an uptrend, the market is here in an uptrend, we have resistance area, and then on the breakout into new highs, the resistance turn into support. And I always would recommend to identify those areas. Where do we have those, I call them flip zones, support turns into resistance, resistance into support. Those can be really, really helpful tools, especially then if we look for reversals. So what we can see already here is that we have a head and shoulder, right? We have the left shoulder, the head, and then the right shoulder. However, we don't want to short until the market is moving lower. We need to see a structure change, a trend change. And this happens when the market falls back below that. If the market breaks below this level, what does it tell us? It tells us that it was not, or the market is not able to establish this as a long-term support. And the market is finding weakness, we're not seeing strength, and the market is not able to continue higher. So the market breaks lower, and let's put us into the shoes of the average breakout trader. The average breakout trader would probably get in somewhere around here. Where is the stop? The stop is up here, right? Above the breakout area, and then typically just here above this level. So somewhere in this zone, you're gonna have a lot of stops. And if you are a breakout trader and you have been struggling with breakouts and you have been approaching them this way, then there is a very important lesson here. And the breakouts, and I've been trading breakouts for well over 10 years, and I have seen that in the last 3, 4, 5 years, breakouts have become less profitable and breakouts have been changing quite a bit. And these days, I would recommend to wait for a stop run. Wait for the market to push back into the zone. It's a very, very common occurrence these days. Wait for the market to push back into the zone and then turn around. You can see that. You see the market is pushing into the zone, and this is what you want to see. You want to see a lot of speed. You want to see a lot of movements. Many traders will say this is volatility, this is noise. And yes, but in the context of where this is happening, this is just so invaluable to understand. The market is pushing into the zone, it's hitting those stops and then reversing. When a market is able to do that, hitting stops and then reversing, coming back outside of the pattern, this is a stop run. This is very, very important. This is a very important signal on your charts. A lot of breakout traders have been liquidated here, and the market is still here below this area. So now this becomes a very bearish signal. And you can see afterwards, the market moves lower, moves into the previous lows. So the target-wise, this makes for a good target and such an important pattern. This is not changing the overall sentiment. This is not turning this head and shoulders suddenly into a bullish scenario. This is not invalidating the head and shoulders. This is, if anything, making this pattern even more valuable. A stronger signal is being created here when you see the stop run, and the volatility and the speed of the stop run, the strength of the stop run is here what is selling us. What is really important is to see a strong reaction. It doesn't have to be in one candle, it can be 2 or 3 candles, but in general, you want to see large candles, strong moves, and a lot of momentum here. This makes this a great, great pattern to know. Now let's take a look at trap and fake outs, and here we are also using some liquidity concepts. And if you are struggling with trading breakouts, and if you are one of those traders that also message me and saying that you often run into fake outs and that you have no idea on how to approach those levels professionally and with more accuracy, then you have to listen to this lesson. So very often you come across a market where you have those long-term resistance or long-term support levels. They can stretch over weeks or months, and then you are seeing a strong breakout. And what many traders, especially the amateur traders, do is that they just jump right into the market. They also see that the market has made a huge push and maybe they haven't participated in the move and they feel that they have missed out, and FOMO kicks in, the fear of missing out. And then the traders find themselves in a long position. However, there are a few things absolutely wrong with such an approach. First of all, you can see that the market has already made a significant move, especially here in the last half of this bullish push, there was no real pullback. And the longer the market is going on and the longer and stronger such a push is, the higher the likelihood that you will see some type of pullback and some type of correction. So jumping on those long moves without a correction, I would really discourage you from doing that. Also, think about it. The traders who bought the market up somewhere around here, where will they have their targets? They will have their targets right around the support and resistance area, right? That's how you are usually taught to approach the market. You look for the big levels, and that's where you take profits. So we'll have naturally a lot of resting sell orders sitting here. So there's a lot of liquidity in this zone. And that's why we have to be so patient with those levels and those markets. Also, you will have a lot of other noise here. Pending breakout orders will be clustered around here, and the people who got into long breakouts here, they will have their stop loss around here. So you'll have a lot of liquidity here. And what I would recommend you, the first tip that you should apply is be patient. Don't just jump onto a single breakout candle and wait until the market is providing more information. Just waiting a few candles will make such a huge difference. If you're looking for a trend continuation around such levels, wait for a pullback. If you want to buy, then you want to buy for the lowest possible price. The lowest possible price can often be found around retests. So you want to see the market pulling back, and not just a shallow retest. You really want to see that the market is pulling back and then moving back into the initial trend direction. That's something a lot of traders get wrong. What many do is that as soon as the market pulls back, then they will jump onto a buy. That's not what you want to do. You want to wait for the market to pull back, but you want to see that the market is continuing into the initial trend direction. You want to go with the momentum. You want to see the market moving higher. So this is not a retest yet. It's a retest in the making, potentially, but we are not retesting anything meaningful, and we're not seeing anything bullish here. And what you can see just a few candles later is the market is back below the range. And that is definitely not a bullish market. So just sitting on your hands and waiting a little bit longer can often save you so much trouble. And if there's one thing that I would recommend to amateur, new traders or struggling traders is that learn to sit on your hands a little bit longer. Wait until really everything aligns. Wait until the setup becomes clear. And very often you will find that you are glad that you haven't taken the initial impulsive entry, and you are glad that you have waited more. Of course, there could still be a chance to trade a long position here, but of course now you don't want to do that. You want to see the market continue a little bit higher. And what we can do as a fake out trader, if we want to fade those highs, we go to a lower time frames. We go from the 2-hour to the 15-minute, and here we are seeing that the market is testing a pivot point. This is a daily pivot point. I made other videos on how to set it on your charts and how to add it in TradingView. And what you generally want to see is that you are seeing here, first of all, lower highs, and you want to see the market break a pivot point. You don't want to be short a market as long as the market is above a pivot point. So we wait a little bit longer until the market is really breaking through the pivot point. We also at this point see a true structural change. You will see that here during this downtrend, this is the first time that the market makes a new significant lower low. So we are making lower highs and we are making lower lows. We are retesting previous support as resistance, and then the market has a much higher chance of continuing to the downside. And yes, you might ask yourself, wow, that's a lot of waiting. Is that really necessary? You tell me, how is it working for you of always impulsively jumping into the market? I've been working with traders for many, many years, and I have seen often and most of the time actually that waiting longer will usually make you a better trader. You can avoid a lot of those impulsive mistakes, a lot of those impulsive trades. And then you can see the market rolls over, not immediately, but you can see overall the trend direction has completely changed. We had to wait for a complete structural change. We see the lower highs, we see the lower lows. We have the long-term fading of the level, and then you can see the market is moving for hundreds of pips, and that is where you want to trade. You don't want to be an amateur trader that just impulsively chases those long entries. This is not going to work long-term. Learn to sit on your hands, and this will do you very well in your trading. Everyone loves supply and demand trading, and here I have some really interesting and really helpful supply and demand trade studies. And what we do is we start on the 1 hour time frame. We are here being able to identify this long-term support level, and the market is breaking this level. But the break is here really what matters. And whenever you see such a huge candle, whenever you see such a huge shift, this really deserves your attention, because we are looking here at a Forex pair, and Forex is the largest market, and to generate such moves and to make the market move in such a fashion, it requires a lot of money and a lot of force, a lot of interest from one side, and a very, very unbalanced market. So really, class, something very significant, very, very meaningful must have happened here that drove the price down. And first of all, we don't chase such moves. We are trying to identify them. They're very easy to identify because they're standing out. And then what we do is we draw our supply and demand area around this. So what we do is we draw it, and then we just stretch it forward, we extend it into the future, and we wait for the market to come back to such levels. And here what we see is the market first comes into the previous support, this long-term support level that we have drawn here. The market comes back into it first. We don't touch the supply and demand zone, but we reach this area, and we see here an engulfing candle, a very strong signal. And we can find often good trading scenarios around those areas. So what we do is we wait a little bit, we wait for a pivot change. The market in an uptrend trades above the pivot, in a downtrend trades below it. This is our first change, and then you can see the market rolls over. We trade into the previous lows, and this could have been your first interesting trade scenario here along those long-term support resistance levels. However, other traders will choose to wait for the market to hit the supply zone. This happens a little bit afterwards, just a few candles, a few days afterwards, the market is back into those areas. And this is a very simple trading approach. You just identify those long-term supply and demand areas, you wait for the big supply and demand areas to form on your charts, you set your price alerts on TradingView, and then you can close your platform until your price alert gets triggered when the price is back into the zone. So that could be a great way and a very low maintenance trading system that you could try to backtest and to see how it works for yourself. So the market is back at the zone here. What we see is that on this time frame it's barely visible, but we are seeing lower highs. When we zoom into the lower time frame, we go from 1 hour to 15. You can see the market is making some consecutively lower highs. We have the lower bounce here, which is an extreme sign of exhaustion. So clearly the market is here seeing a lot of force, and this is typical when the market hits those areas. Not always, nothing works 100% all the time, but this time the market seems to be picking up short momentum. There are a lot of interest here, probably also a lot of traders who bought the market up have their targets around here. So we see a break and retest pattern. The break and retest pattern may have not worked out, and I picked this example intentionally because I want to show you that nothing works 100% of the time. There will always be winners, there will always be losers, but if you're patient, there might come a second chance around, and the market comes back here. We pull back into this area. On the long-term time frame, this will look like a supply and demand stop run, right? So the example that we had before with the stop run, liquidity run, the market is back in this area. A lot of breakout traders who trade the breakout here will have their stops in this zone. The market comes back into the zone. We have here previous support turning into resistance. Then we could have used this as a secondary entry opportunity. This here is not changing the overall bearish sentiment, right? It still overall looks more bearish because we are here below the support supply and demand area first of all, but we are also trading below this high here. So we are more bearish than bullish. We are still looking for bearish opportunities, and then we could use this as an entry opportunity. You could also wait a little bit longer for the market to clear such areas, and then you can see the trend unfolds. So nothing works 100% of the time. This is one of the most important criteria and most important concepts that you have to understand as a trader. You have to get away from the idea that you find something that works all the time. You have to be instead okay with experiencing losses occasionally, but when the good trade comes around, you have to be able to ride it with confidence. You can see here, theoretically, you could have stretched it to a 5 or even 6 to 1 reward to risk ratio. Even if you take 1, 2, 3, 4 losses previously, this will still net you a profit overall. So it's really important that you stay patient, that you not lose your head, you close your loss when your trade idea is proven wrong. So you don't let a small loss turn to a big loss. And then long term, this is where you will then be able to trade at a very professional level.